Imagine having a 95% win rate and knowing you're going to win that day. Now I have made over 6,000 bucks just trading that stupidly simple strategy. Now as you can see on the start, we had a little bit of downsides. That was the period when I was just developing the strategy. But over some time you can see that the graph is looking very professional. That is basically what I've been doing for the past 3 months. And here's one of my recent trading activity. You can see that we have not taken a single loss in 3 months. But I'm not the only one. Everyone participating in a live trading session is also on a high winning streak. So far, not anyone in the Discord has lost a single dime off of my trades. So how was I able to pull this off, you might ask? There's 3 things in trading that you need to master: psychology, strategy, and risk management. In this video, we're going to focus on my high winning strategy and also risk management. Now, risk management is by far the easiest part that you need to master in order to be profitable, but it's very misunderstood. Now, on the surface, it is really just basic math. 1 plus 1 is 2. You can do that? I think so. It is by far the easiest thing to understand in trading. However, it is so powerful that it single-handedly is able to prevent me from losing funded accounts, challenges, or personal accounts, you name it, guys. So although I have a low risk to reward, which makes a lot of people think that one loss wipes away the entire account, but that is not the case. When I'm losing the same amount as somebody would lose with a 1 for 2, 1 for 3, 1 for 4, whatever you want, guys. Now the reason why high risk reward has never really worked for me is because it has a low winning rate. I rather focus on having a high win rate, and I'm able to withstand more drawdown. That is easier on my psychology because every day when I come into the market, I know that I'm going to win. Now, and of course, many will say I've seen people catching 1 for 3 trades with an 80% win rate. Now, to put that into a perspective, to give every one of you a quick reality check, let's say you start with a 1k balance. Everyone watching can have 1k in their pocket. Just work hard for a month. It's really not that difficult. After 16 wins and 2 months of trading, you have 1 million. Now, after another 16 wins and 2 months of trading, you're a billionaire. If you do that again one more time, you become Mansa Musa. If you don't know, that is the richest man that has ever lived on planet Earth. And if you do this one more time, you'll become this guy. Now, even with unrealistic stats like this, you're going to lose here and there. But eventually, if we assume you're taking 8 trades a month, now you get my point. These ridiculous claims are kind of funny on one side, but it is tricking new traders into believing that this is actually trading. And I've been there too. I've watched all of these different gurus stating that they turned 100 into 1 million. No, guys, stay away from the gurus. Do what actually works. Now, thankfully, you're at the right place. I'm going to show you what actually works. Now, let's just assume you're trading on prop firm accounts like me. I manage over 500k in total funding. So if I want to risk 1% on that trade, that is basically 5k. Now, 5k seems like a lot, but it is really just that 1% from 500k in total. That's simple. My point is that you always have to look at it percentage wise, because oftentimes when somebody sees my low risk reward, they like to hate on my strategy because they believe that I'm going to lose my entire account. And yes, I'm losing a lot of money, but am I gaining more money while also losing? That is the entire point of trading. You're losing, but you make all of the losses back and become into a surplus. This is basically trading. Now, on a lot of firms, your max drawdown is 10%, and on some, it's really even just 8%. So it means I would have to lose, for 8% as an example, 8 times in a row in order to blow the account. For 10%, I have to lose 10 times, so 10 losses in a row in order to blow the account. Now, to put the chances into a perspective, losing 10 times in a row with a 95% win rate is this number. It's 0.000 and then eventually 98. To put it into a different perspective, flipping a coin and getting heads 36 times in a row, 1 in 68 billion, but this number is still less likely. Being struck by lightning 5 times in your lifetime, 1 in 10 billion, still this number is less likely. So you get my point. Basically, it's impossible to lose 10 times in a row with such a high win rate. Now on to the strategy that I'm using myself, focusing on a low risk reward but a very high win rate. You're going to look at one pair and one pair only every single day, which is EUR/CHF. You can trade the strategy or this entire risk to reward approach if you want it as a whole on any other instrument, but I recommend sticking to one pair which is real CHF. Because if you just concentrate on one thing, you'll become insanely good at it. When I hop into the chart, I only need 5 to 10 seconds in order to know where the price is going to go next. Because I've been trading USCHF for so long, I know where price is going to go next every single time. Now think of it as like a business. If you're just starting out and you eventually just drop the idea, you have to start all over again with a new idea. You're hovering around, but then you don't like it, you're starting a new idea. You have to start at the bottom once again, and that goes on. But the guy who just consistently stood to one thing, right? He is eventually going to shoot high up onto the air, profit-wise, progress-wise, everything, because he is just sticking to one thing instead of always changing the things up. And this applies to everything. Are you the kind of guy who is constantly hopping from strategy to strategy? Because if yes, then this will not work. You have to stick to one specific thing at a specific time, at a specific pair. That's it. Now the strategy doesn't have a specific time period that you need to look out for every single day. That's the beauty of it. Most gurus try to hook you on a specific time that you need to trade on, because that is basically building a schedule. Now at first this sounds very cool, and by the idea it is cool. You know, I give you a specific time, trade at that time, no trade, leave the market. But in reality, a lot of these strategies that don't even work to begin with, but let's just assume they do, they make you tied on a specific time frame. And I know it myself. Having a regular 9-to-5 job while also trying to learn trading is extremely hard, because I had to juggle a job while also trying to juggle trading. And that is very hard, because when I need to trade, I'm at work. But in order to get money, to even start with trading, I have to work as well. So it doesn't go hand in hand. But what I do is completely the opposite. I don't tie it to a specific time of the market, because you can trade the strategy at any given moment. Now you might say, how is that possible? Because as long as the higher drawn liquidity, which is this one in this case, did not get hit, you can take a trade on to the upside at any given moment, as long as your main target did not get hit yet. Now how do you identify the main target to begin with? This is where we get into a more technical side of things. I like to look out for easy draws on liquidity, areas where the market will be easily violated due to a lot of stop loss being above this high or above certain lows. Now believe it or not, but the market is actually hunting your stop loss. Regular people see this as resistance, but it's the complete opposite. We will trade onto the relative equal highs, as I mentioned in my mentorship, because this is exactly what the market likes you to think. They want you to believe that we will trade onto the upside and then trade all the way lower. But everybody who took the trade above this line is likely being stopped out. So what we do, instead of trying to short it, we're trying to long it into the relative equal highs and having a fairly big stop loss. Now before you get into the market, you need to know basic rules. You're not going to trade every single day. There will be days where you're not going to take a trade. You should not take every single day, because not every single day is high probability. Now you might ask, how do I know which day is high probability and which is low probability? Well, I have found it out for you. So basically, NFP days are a complete no-go. If you go to forexfactory.com, you'll see that sometimes we have non-farm employment change news. If you see that kind of news event, don't trade that day. It's that simple. Now the next thing is first 3 days of the month. There's also not going to be a trade. Now this rule aligns very well with the first one, because on the first 3 days, often we actually have NFP days. Most likely it's on a Friday, but there's also days where we have it on the Tuesday or Thursday, so we're also not going to trade these days. How do I know it? I'm not just pulling out these rules out of my asshole like any other guru you're watching. I actually know the shit, because I've backtested it over 3 years of data, and in my data it has shown me that trading those kinds of days will have a low probability. Therefore, we're avoiding them. Now obviously you're only going to trade the best trading days and also best trades as a whole. No modifications on the trade. What I mean by that is, once the stop loss and the take profit has been determined, you don't move it. In this way of trading, there's only two outcomes: loss or win. Most likely, and pretty much always, it's going to be a win, but only if you leave the trade as it is. Now guys, you can have the best strategy, the best risk management, and also be a master at psychology, but every professional trader needs a professional journal. That's why I personally use TradeLens. Now if you want a 10% discount, it's the second link in the description. Now as I have told you previously, this is not resistance, but we're going to trade higher onto them. Oftentimes when something is not working in trading, you have to reverse the entire script, because there's only two sides the market can go: up or down. Now after identifying the relative equal highs and lows, I like to look out for additional information to stack up the confluences on why price is going to a specific level. One of those confluences are previous day highs and lows, but not in the very regular way where you have a previous day high, you like to be taken out with a sweep and then you go lower. No, we do something completely different. Basically the opposite of what everybody is trying to do, and they're losing with it. It's not even working. So basically, when this candle opens, I like to trade onto the previous day high, not the low. Now many overcomplicate it. I'll make it very simple for you. Go onto the daily chart after this video and check it out yourself. There's only two things the daily candle will do, either taking out the high or the low. Now bear in mind, the next candle is going to go for the previous day high, but it might as well also go for this FEG, which we're also going to talk about in a second. But it doesn't matter at the end, because even if this candle reaches for the previous day high and then decides to go lower, it doesn't matter, because the drawn liquidity is only the previous day high. That is all we need. So a lot of people like to look out for that big profit, 10-hour trade. No, you like to look out for small steady growth over time, which you can then compound, and it will make you a lot of money. So everything that happens after taking out the previous day high, we don't care about that, because 90% of the time, based on my backtesting data, we will take out the previous day high or low. But there's two exceptions that you have to look out for, and if you're missing them, then don't be surprised why the strategy doesn't work. Now sometimes, on some very rare days, we're not taking out the previous day low and also not the previous day high. As you can see, this candle, this bearish black candle, did not take out the high or the low. That's a rare occurrence, and this will not happen a lot of the times. Now the next pretty rare thing, and once again I'm not pulling this out of my asshole, I've backtested this. You can try it yourself. Go back in the chart and look for it out. This candle took out the previous day low and the previous day high. So remember, I told you it's either going for the previous day high or low. But in the two exceptions, it's not going for either of them. This is the first exception, and the second exception is that's going for both of them within the same candle closure. Now, how do you know and how do you avoid those days? It goes back into the rules that I've presented to you earlier. So now we have two things: relative equal highs and lows, and also previous day high and low that we like to look out for. But there's a third one that is very important. And the next thing is higher time frame FEGs and price gaps. Give me 10 seconds to quickly explain what an FEG is. Basically, we have candle number 1, candle number 2, and candle number 3. If you extend candle number 1's wick all the way to the right, and you're also able to extend candle number 3 all the way to the right without interfering with each other, then you have a gap right in between. So this is a bullish FEG. The same goes for the downside. Now price gaps are a little bit more special. I like to call them the big brother of FEGs. It only consists of two candles, candle number 1 and candle number 2. If you can see, right in between the price there is a small little gap. That is an entire price gap within the price action itself. Now why do we care about them? FEGs and also price gaps like to be traded back into. As you can see, we had this FEG and we traded back to it with a wick. Only then we traded lower. We basically always like to trade back into them unless it's very rare and extreme market conditions. But FEGs are only the little brother of actual price action gaps. Now there is something special about price action gaps because they don't work the same. Not because they just look different, but they also work different. Now first of all, as you can see, we had this FEG, which I'm going to draw at another time. We traded back into it with a wick, and that was enough for price to tank lower. But for price gaps, it's different. We have traded onto this price action gap multiple times. Price gaps work differently because we need to get back into it with a body closure. What do I mean by that? If we zoom in a little bit, we did not trade back into the gap until this specific candle. Why is it this one? Because the body of this candle filled out the entire gap. No, this candle was not enough. It did not trade quite into it. So the trade is still valid. Now gaps on their own are a very high probability. The reason for that is because as long as we did not trade back into that gap, look how many chances you would have gotten long into that level. 1, 2, 3, 4, 5, and only by the 6th time from there on you can start taking shorts. You have taken at least by the minimum 6 trades onto the upside and traded back into the gap. Now a lot of people say, how do you know which candle of those to choose? It's any candle. That's what I've told you earlier. You can take this strategy onto any time frame and trade it at any given moment. If you now take a long tool, you could have traded any given candle at that time. Our stop loss is not going to get hit because we have a low risk reward. We don't care about predicting the exact tick in order to hit our take profit. We focus on small steady growth over time. Now here's one of the recent trades me and the students in my mentorship have taken. First, we identified the relative equal highs on the hourly chart. Even though it looked like a massive downtrend, I knew that this level has to be taken out, because there's a bunch of stop losses waiting to be taken out. Stick to analysis and don't change the plan. It's not that complicated. Now the next thing that I was looking out for are weekly price gaps. We have just talked about how easily simple they are to trade. We have not reached into it with a body closure. You might say, well, if you know that we're going to go for the high of this entire price action gap, why are you not trading back into it? And this is something that I've been saying for the longest time. if you're trying to go for massive profits within a single day, you're not going to get there. You have to build steady growth over time and compound it and compound your gains, because if you're compounding your gains, you will become rich. So after the relative equal highs were confirmed, we're easily taking a trade, stop loss fairly big, and that is a very easy take profit hit. Now as always, I'm not just pulling that out of my asshole. You can go onto the Discord and check it out for yourself. The trade has actually been taken live and it has hit take profit. You have made it this far into the video. And let me be very clear about this one. You can go two paths in trading. Either you're taking the path that I had to take, which led me to countless of profit challenges being blown, and also personal accounts that I have lost. The list goes on. Or you can also take the shortcut, being mentored by somebody who has 5 years of experience, more than 500k in total funding, and also multiple prop firms. Now I have been interviewed by prop firms where I basically explain how I've gotten to all of those payouts. When you're trading for this long, your win rate is extremely high. That is why we barely get into any kind of drawdown. Now, and this is not just a regular mentorship, you will get access to everything I have learned over the past 5 years of experience. So if you want to learn how to get the same results, it's the first link in the description.